Hi there, and thanks for taking the time to join us for this presentation. I was a little bit under the weather for the original Ninja Trader presentation, so I decided to make a new recording of this webinar. Still a little bit under the weather, but a lot better than when I held the original presentation. So that's me to the right, Chris Lassen, and together with Harry, many of you know him as Fat Tails, I founded Lizard Indicators back in 2014. Over time, we've grown to support traders across a fairly broad spectrum. Some work almost completely from a discretionary price action point of view, whereas others are deeply systematic and want every idea translated into logic before they execute on it. So we work across two main indicator suites. The first is our famous indicator library for NinjaTrader 8, open source collection with well over 145 indicators there. The second is our premium suite, where we focus more on proprietary tools with structure, filtering, timing, and execution logic. And finally, we have something that takes our indicators to the next level, the Strategy Toolbox. That is a framework designed to help traders build and evaluate their own systems using our sample NinjaScript templates, as well as the products from Shark Indicators with our library and premium suites. So this is about how to turn trading ideas into a rule-based approach. Our goal here is not to offer a holy grail or so-called turnkey strategies, more about following a process to find out if a setup is likely to produce profits in a live scenario, and then also show how to maintain a system moving forward. So over the next 40 minutes or so, we'll move through three layers here. First, we'll start with the classic candlestick pattern analysis and look at why they often behave differently than what you'd expect in today's markets. Secondly, we'll have a look at why predictable positioning is part of the problem, or order clustering. And finally, how the broader market auction can give us a more structured way of identifying the same underlying reversal mechanisms. And from there, we'll connect to the strategy toolbox, testing a trading idea rather than simply trust something you've heard from a trading guru or read in a book that was published 10 or 20 years ago. So not really about how to analyze candlestick patterns here today, more about how the underlying market structure has evolved and understanding that, because once you begin paying attention to that point of view, price action setups become much easier to evaluate. So candlestick pattern analysis originated in Japan some 200-300 years ago, and compress trading behavior into a visual language. So each candle captures a miniature auction, buyers and sellers negotiating value, exploring higher levels, testing lower levels, orders transact, imbalances occur, and eventually the price settles and the bar closes. So each candle is a summary of that negotiation during a defined interval. And it's important to pay attention to the time frame, because that really matters. On daily bars, the open and close carries much informational weight because it reflects broad participation, across the full session. There's a large number of transactions, obviously, decisions and participants interacting. And so that gives stability to the visual structure of candlestick patterns. But once you compress the same logic into a fast time frame, that stability changes, because now the same visual shape is produced by fewer participants, and less participation means that short-term distortions are much more likely. So a 5-minute Morningstar pattern may look decisive, but structurally it could also just be a brief imbalance with little significance in the overall market play. In other words, a pattern on two different time frames can look the same, but carry very different structural meaning. So depending on the instrument, a daily candle can compress hundreds of thousands or millions of transactions, whereas a 5-minute bar only captures a fraction of that. And with fewer participants, visual structure becomes easier to exploit. The statistical weight behind the same geometric pattern decreases. And when statistical weight decreases, obvious intraday structures can become quite fragile. If you think of it, an obvious low on a fast chart is really just a low. It's often also a visible cluster of stops, and a obvious high is often visible liquidity. So what traders often interpret as failed reversal may simply be price interacting with that predictable positioning before direction becomes clearer. And that is why we should be a little bit critical of many textbook interpretation on fast timeframes, not because the visual language has disappeared, but because this short-term liquidity often interferes with how we expect the patterns to behave. The shorter the interval, the more careful we need to be about the conclusions we draw. And that's much more of an issue today than, say, 10 or 15 years ago. Here's a slide to illustrate that point. A textbook reversal. The structure is obvious. One side in control, that control weakening, and the opposite side beginning to respond. An entry near the close of the final bar, and the stop placed just beyond the obvious low or high here, as with the evening star. The problem is that this obvious structure often creates predictable positioning, as mentioned, also known as liquidity. So what one trader sees as a reversal, other participants may see as accessible resting risk. And that is why many classic reversal patterns fail in the fast time frames. Price moves just enough to confirm the signal, and then a stop run before the direction resumes. Well, that does not necessarily mean the pattern itself was invalid. It means that the path towards validation has changed. So the main difference between higher time frame candlestick logic and intraday execution is that on fast charts, the visible structure tends to become a part of the auction itself. And that is why the morning star and the evening star patterns are really one expression of a broader family. The harami, the tweezers, tops and bottoms, the shooting star, bullish hammer, engulfing patterns. different names, but often the same underlying sequence. One side in control, control weakening, and the opposite side beginning to respond. Visually, they appear different, but structurally, they describe the same auction behavior. And that's important because once we recognize the underlying mechanism, the candle names here are no longer so important. The difficulty is that once we move into the fast intraday timeframes, that shift of control does not always carry equal weight, regardless of the pattern we're talking about. A reversal in the middle of the day may turn out to have a different expectancy than one that plots during the first or the last hour of the regular session. So those are sort of the hotspots of participation. And a reversal forming in a random area may also have a different probability than one plotting near a key support and resistance level. So a practical approach would then be simply to ask, how do we define the time windows and locations where reversals are more likely to see a follow-through? And that is where conditioning begins. Instead of assuming that the pattern itself has an edge, we ask whether the surrounding conditions can improve our statistical probability of success. And one of the simplest way to improve any reversal logic really is not to change the pattern itself, but to ask when it appears, because markets do not distribute participation evenly across the session. The first hour tends to concentrate the opening imbalance. That's where the overnight inventory gets corrected and fresh positioning enters and early directional decisions are formed. And towards the middle of the session, behavior often changes. Not always, but I think it's obvious enough that you can just pull up any chart with the basic volume indicator and see for yourself. And then into the final hour, participation will typically increase again as positions are adjusted, hedges are completed, and intraday positions are settled. So before changing the pattern itself, we should verify if it behaves differently when participation is concentrated. So, for example, a morning star that shows up during the first hour of trading may have a better chance of predicting a move than one which appears around lunch hour. The visual structure is identical, but the surrounding participation is different. And that alone can change the statistical outcome. It's not about whether the pattern is geometrically valid, but whether the market is fully engaged. The second layer is location. Certain levels matter consistently. A reversal in the middle of a random area has less meaning. This morning star pattern here, for example, did not align with any obvious support resistance level, at least on this chart. So it fell victim to what I mentioned earlier, a liquidity event here with the stop run. Whereas reversals that appear at the pre-session low look much more interesting. And the reason is simple. These are objective key support and resistance levels that traders will pay attention to. So the pre-session high and low, yesterday's close, yesterday's high. When price interacts there, we are no longer looking at isolated candle geometry. We're looking at a visual event that plots where traders already know what they'll do. So it does not guarantee a reversal, of course, but it does increase the chance that the shape actually reflects decision-making rather than just noise. Still, in recent times, and I'm referring to AI here, even this type of conditioning is becoming quite obvious and will over time probably create a new round of predictable positioning traps. The question then becomes, how can we maintain a forward stance, stay innovative while being structured when it comes to location? If we move beyond the pre-session and prior high, low, close levels, the first and the last hour of the session, we can look at the ranges that larger participants typically pay attention to. And those are 1 hour, 4 hour, and daily bars. Why those? Because they represent broader value negotiation. So a 5-minute reversal that shows up at the edge of an hourly range means that the price is interacting with a broader auction range. So instead of asking whether a candle looks bullish or bearish, we ask if it rejected a higher time frame extreme. And that leads us to the auction bars indicator. Our primary focus then shifts from naming the candles and instead look at the higher time frame auction ranges and then see if there's reversal behavior around those areas. So structurally, we're looking at two types of reversals, spike and key reversals. And we also distinguish between single bar and composite reversals. Composite is where two consecutive bars are merged together and describe the same exhaustion behavior as you would have on a single bar. Because our goal here is not to create a bunch of pattern names, but instead to reduce many familiar visual forms into fewer structural mechanisms. And I'll show you this in chart examples coming up here. We're not really replacing the candlestick logic, but instead expressing price rejection in a more structured way. The main difference is therefore that reversals have to intersect at the higher time frame auction ranges, and that immediately removes a large number of middle of nowhere signals that may look convincing visually, but carry little structural weight of what's going on in the background. So location comes first, and the visual shapes come second. So here we have a 5-minute chart of the Nasdaq contract using a 60-minute auction range. And this chart really shows why the framework is quite useful. The bearish spike forms directly outside of the 60-minute range, not somewhere in the middle here. And that's important because price is testing whether value should expand higher. The attempt failed here, and price rotates lower, but still managed to close outside the upper edge of the range. That creates a new auction range, and once that breaks, we see a bullish key reversal at the new lower boundary. So already in one chart, we have both structural ideas, a spike at one extreme and a key reversal at the other, and neither are interesting because of the candle appearance alone. They're relevant because both occur where higher time frame value is being tested. And that is the core distinction here. We're no longer reacting to isolated 5-minute shapes. We're asking whether those shapes appear where the broader auction pressure makes exhaustion plausible. And to be precise about what qualifies as a spike bar, at the most basic level, we're looking at rejection inside a single candle. So for a bearish spike, price pushes higher, leaving a pronounced upper shadow, fails to hold those higher prices into the close. And for a bullish spike, we have the opposite, price pushing lower, leaving a pronounced lower shadow, and then closes back higher with a small body. And that visual logic is familiar because traders already know these shapes from classic candlestick work. A shooting star, a hammer. Structurally, they describe very similar behavior. But again, the point is not the geometry of the candle, because the long wick can appear almost anywhere in a fast market, and many of them carry no structural meaning at all. The spike only becomes relevant once it appears at a higher time frame auction range. And that is where a visual rejection starts to become meaningful. And once a spike has the right shape, it still needs to qualify as a candidate. And this is where filtering becomes important. We can require minimum volume relative to the recent bars. That, of course, helps to ensure participation. We can require a minimum shadow size, so the rejection is significant relative to recent ranges. And we can require swing strength, meaning the bar must set a meaningful higher high or a lower low, rather than just a minor fluctuation inside a noise area. And that ability distinguishes the auction bars indicator from most of the candlestick pattern studies that I've seen. Again, it's important because fast charts produce far too many bars that look visually interesting, but carry little structural weight. And by using this approach, we can ask, did price reject an area and in a way that deserves attention? And if not, the pattern will be ignored. But even once the candidate qualifies, it's still not a confirmed signal. And I think this is where the auction bars indicator differs most clearly from classic candlestick entries. The spike begins as a reversal candidate and only becomes a confirmed reversal once price confirms it. So for a bullish spike, price needs to take out the high of the setup bar, and vice versa. For the bearish spike, we need to break below the low of the reversal candidate. So unlike the classic candlestick logic, we're not entering because the candle closed and looked convincing. We enter only if the market shows us a follow-through. So that shifts us from anticipation towards validation. And if the auction bar reversal is confirmed within a few bars, so we have a default confirmation period of 5 bars, the setup survives. And if not, the candidate expires. And that rule alone removes a surprising number of weak reversals. Now, spike bars are only one way of identifying reversal behavior, because not every reversal begins with a dramatic wick. Sometimes the shift occurs by looking at how one bar closes relative to the previous bar, and that is how key reversals are identified. The first and easiest version to fulfill is what we call key reversal type A. For a bearish key reversal, price first makes a higher high, but then closes below the prior close. And for the bullish scenario, price makes a lower low, but closes above the prior close. So structurally, the market extends, but fails to hold that extension into the close. That already gives an indication of a change in the short-term control, captures a slightly different kind of exhaustion than spike bar, where we see the rejection inside one candle. A key reversal shows failed continuation relative to the previous candle. So different appearance, but still the same underlying auction idea. Price extends, fails to hold, and then begins to rotate. And from there, the definition can be tightened further with type C, which is the most restrictive definition. A reversal down has to close beyond the prior low for a bearish reversal, or above the prior high for a bullish reversal C. So now the bar is not simply showing a loss of momentum, it's actively taking out the previous range. Of course, that reduces signal frequency, but it also demonstrates a stronger transfer of control. So it's not really about spotting the optimal definition here. It's about letting you choose how restrictive you want to be with the reversal logic relative to the instrument and time frame you trade. In this example, we have a 5-minute ES chart and a bearish key reversal close below the low of the prior candle. So a type C definition here. We then see a close outside the lower auction range, and then a bullish key reversal close above the high of the prior bar here. So both of these are standard single bar reversals, R1. And later on, we see the composite reversal that I mentioned earlier here, R2. In that scenario, the exhaustion does not complete inside one candle. It unfolds across two consecutive bars. In other words, we merge two bars into one structural event. So if you see here, these two bars are composites. They're put together compared with the two prior bars here. We set a new low on this one and closing above the two prior bars here. So that is useful because visually many trader would still describe that as a familiar candlestick transition, but structurally it's just one reversal developing across two bars instead of one. And again, location here is doing most of the work, as we see all three reversals appear where price is interacting with the higher time frame auction boundaries. We see this reversal straight up to the mid-level of this auction range. So this is usually a good place to have the first profit target. And then you could have a break-even stop on this one. And then the second profit target would typically be up here at the opposite end of the range. So with the last examples here, we showed that once reversals are defined structurally, many candlestick patterns are quite similar, because whether the shift happens inside one candle, across two candles, or through a multi-bar sequence, the underlying mechanics are more or less the same. So a morning star, bullish Arami, or a golfing pattern may all look slightly different visually, but structurally they describe the same transition in control. Of course, as mentioned several times here, it doesn't make the classical pattern useless. It just means that their predictive value improves once we stop treating them as isolated shapes and instead start asking where and under what conditions they appear. So it's not the candle name that defines the edge, it's the surrounding structure that does that. And That's what we address with the strategy toolbox. Under what circumstances are signals able to predict market direction? And we've now just released an InnoScript template for the auction bars. So by working directly with the indicator logic, you can test and adjust spike requirements, key reversal definitions, range and volume thresholds, trigger period, or the higher time frame that defines where to look for reversals. Useful because many changes in those requirements can produce different behaviors. Stricter reversal definition can reduce signal frequency but improve probability. And a different auction range period can reveal a change as to where exhaustion typically occurs. And of course, timing matters. And so you can limit signals to specific participation windows, such as the opening or closing of the regular session. So already inside one indicator framework, the predictive question becomes much more concrete, and not whether a reversal looks convincing, but actually testing that exact structural definition and see how it behaves after 3, 5, or 10 bars. And that is where the visual assumption becomes measurable. You can check the cause and effect and the predictive value of the signals. And once traders see that, the next step becomes much broader than a single indicator, because the toolbox is less about one indicator and much more about building a repeatable workflow for rule-based thinking. So that typically means defining a pattern or event clearly, and then set the conditions around it, measure the reaction, and then optimize on some new observations that you might make, and then finally decide whether the logic deserves live execution. So the same process is what sits behind a number of our premium templates. Earlier this year, many of you saw this applied to the swing trend and the candlestick pattern indicators. These templates follow the same logic and the same broader approach. Also exists for the premium Ichimoku and our zero lag oscillator. And for traders that use the Shark indicator tools, the same thinking also extends naturally into Bloodhound and Blackbird. So the idea is not that every trader has to automate everything. It's more that every trading idea can benefit from being reduced to clear rules and tested before committing your capital to it. So if you'd like to continue working with the ideas from today, we've grouped the key components into a bundle here. The candlestick pattern indicator provides the visual starting point, and then the auction bars add higher time frame structure and confirmation, and the library together with the toolbox will open a path towards testing and creating a rule-based environment. And you'll find the full offer and further details at lizardindicators.com/adept. So the bundle reflects the progression we covered today, from visual patterns to structural definition, measurable logic. And also, if you'd like to sign up for a free trial of the auction bars and the candlestick pattern indicators, you'll find a registration form on that page for that as well. So hopefully today's session has illustrated that But the real question is not whether a pattern still works, but under what condition it still carries structural meaning. Once we move away from isolated candle formation and begin thinking in terms of participation, location, confirmation, many price action setups become easier to evaluate and handle. All right, so that's pretty much a wrap for today. Head on over to lizardindicators.com/adapt for more information. So this connects to the broader direction of what we've been building lately, taking visual ideas traders already recognize and gradually translating them into something more explicit, testable, and adaptable. So with that, I'd like to conclude today's presentation. Thanks a lot for spending the time with me. Appreciate your attention. Chris Lassen signing off from Berlin, Germany. Talk to you soon. Take care and bye-bye.